Hi, and welcome back to our second video on personal financing. Like I said at the end of the last video, this video is going to be about borrowing money and kind of the pros and cons of loans and interest and all of that. Um, so to begin, borrowing, right, is taking money from some sort of financial institution or maybe from a relative or a friend or whatever. And then if you're taking that money from a financial institution, they're going to charge you interest for borrowing their money. So let's say you wanted to get a car, like I was saying in the last video. If I wanted to get a loan for that car, I'd have to go to a bank and say, "Hey, I would like to get a car. I need some money for that. Can I borrow some money from you?" And then I would have to prove that I have some ability to pay it back, right? I got to show them that I have a job. I'm making some money myself, so I'm going to be able to make that payment back to them, and that I haven't messed up with borrowing money before. That's called your credit. So how well are you? How good are you at repaying loans? Um, and then of course they're going to charge you interest because you're borrowing money from them. So they're basically charging you a fee for having their money. Here are some pros and cons of borrowing money. So, for instance, some good things about borrowing money is that you get that money really fast, right? If you get your loan approved, you can go to the bank and you say, "Hey, I need, $5,000," and if they approve you, you can get that money right away. So you can get that money quick. Um, you don't have to work over a long period of time to make that money, so it's really fast. And it can help you with really big things like houses and cars. Some people finance their furniture if it's really expensive, stuff like that. So you can those big ticket items that you want to buy that are really important, like a vehicle, so you can get around, or a home to live in, or those are things that you can use loans for to really help you pay those off, right? Because for a lot of us, we're never going to get $100,000 at a time to just buy a house. So borrowing the money so that you can buy it right away and then paying it back over time is a much more feasible manner for a lot of us. It also lets you spread out the payments, so you don't have to pay for everything all at once. You're borrowing that money up front, and then you're paying back over an amount of time. So, for example, a mortgage usually lasts 30 years, so you're paying that back over a long expanse of time, and that means that you don't have to pay as much, right? So you're instead of paying $100,000 for your house, you're paying smaller portions of it every month. And then also by borrowing money, you're establishing a credit history. So for me, right, I've taken out several loans, right? I took out a loan to buy my wife's engagement ring. That was a big payment that I wanted to make sure I could do. So I took a loan for that. I've also me and my wife have taken out student loans, and those loans are money we got afford to pay for school, and now we're paying them back over time. And so a credit history kind of details all the things that you've taken out loans for, and then how well you've paid them back. So because banks and stuff are going to look at that and say, "Oh, you didn't do such a great job paying back those other people. We don't want to give you any money either because you're not going to be able to pay us back. They don't trust you." Some of the negatives of borrowing, obviously, are the interest, depending on what interest rate you get. Some interest rates can be really low, like sometimes mortgage loans can have like down to 3% interest. That's a really good interest rate. Some credit card companies, they charge like 30% interest. That's a lot of interest, right? That means that they want to make sure that when you buy something with their money, you're going to be giving them back all that money back plus 30% of what you spent. That's a lot to have to pay back extra. So watching those interest rates is important because that can be a downside. The other thing is if you do end up falling behind on those things, then there's some legal repercussions that can happen to you. For instance, let's say you bought a car with your loan. Well, the bank can take that car from you, and if that's not enough to satisfy the debt that you owe them, they can take even more from you. They could take your home. They can sue you for more money. There's a lot of different kind of murky legal things that can happen to you if you do end up falling behind on loans. So that's why it's important to think about those sorts of things when you're going to be borrowing money. Now, to be fair, though, it is important that maybe even when you're younger, around the age of high school, maybe a little bit afterwards, to establish a line of credit and to do it safely. So when I was 18, me and my dad went and we got a credit card for me, and that credit card was through some organization he was a part of. And he was able to, and you could apply for any sorts of, you can go to a store and apply for a credit card. Like you can go to Target. They have those cards. My wife has that one. It's a really great card. Gets you some money back. There's some perks to it. And that allows you to establish a line of credit, and it's allowing you to do it pretty safely as long as you don't overuse it. So for instance, when I had that credit card, I only used it for emergencies. So if I was, my car broke down and I needed to pay for something really expensive, right? Like my tire blew out and that was expensive. I could use my credit card for that, and then I could pay it back later because I didn't have the money on me. Or what I would do is I would pick one thing that I would purchase with my credit card, and that would establish a credit history for me. So I always bought gas with my credit card. So whenever I go fill up on gas, instead of paying with my debit card or with cash, I would pay with my credit card, and then I'd always pay it off at the end of the month. So at the end of the month, they'd send me a bill and they said, "Oh, you spent $80 this month." And then on those bills, they always give you like a minimum amount you could pay. So if you want to just pay, $20 of that, that's like usually the minimum. And so then I would never do that. I would always pay the full thing off because I knew I had the money and I was trying to just establish a credit history. So when you're young, that's something that you can do to kind of build up that credit history. And then when you're older and you need to get a bigger purchase like a car or a house, the bank will look and say, "Oh, look at how responsible this person is. They have been borrowing money and paying it back. That's fantastic. We can give this person a loan." So now that I'm able to do that, I can get bigger loans, like for my house and other stuff like that, with relative ease because I set up a credit history beforehand. Also, if you're in high school and you're about to get ready for college, you're going to end up probably taking some student loans if you do end up going to higher education. Even if you go to like a trade school or something, they're not cheap. And a loan to get through that is going to be something that you might have to do. Now, student loans, they're pretty much going to accept you no matter what your credit history is. But you do need to look into those loans and see what kind of interest rate they're charging you, right? Because as we said, that was a negative of, how high is that interest rate? How much do they expect you to be paying back and how quickly? Anyway, that's my episode on borrowing money. The next episode will be about investing and what you can do with the money you have and how you can set yourself up for later on in life. Thanks. Bye.